evening. That was really some great information. You're learning as entrepreneurs and business people to set the vision, find the resources. And our next speaker, Mr. Blackwell, is going to help you with strategies to set up and utilize that business credit and monetize it. There's a lot of different resources out there. Of course, he's giving you like a week's worth of information within an hour, and we realize that. But he's got a lot of handouts you could utilize, and all the information that Mr. Blackwell is talking about is also with the SBA. You notice I keep going back to the SBA. All of their programs are listed, and it's in the information that we provided for you. And of course, you can talk to us on Saturdays for our office hours. Mr. Blackwell is an accomplished banker, business development officer, and financial analyst. He operates in the County of Los Angeles and also the Inland Empire. He sits on multiple boards, National Black MBA for one. I'm with that organization as well. And so is John. You met him last week, actually. So without further ado, please give him a warm welcome and ask a lot of questions, because he can tell you how you go about getting the money for your business.
Good evening, everyone.
Good evening.
You still have to put her in?
I don't want to leave it. You know, you walk away, go, wait a minute, I want to walk away.
So there's a couple things I want to touch on that she mentioned that's really good. And I know you were trying to create some time for me, and I'm taking notes myself because we're always learning. One of the things with the DMV, a lot of times they will try to get you to pay for a lot of the things that you can do. She mentioned it's free. We always, in the banking space, in the commercial lending space, will check to see if you have a DMV. And everything she mentioned is extremely critical, because different banks, different institutions sometimes will lend. Even the banks themselves will often have programs where they will lend off of your DMV. So if you build it right, you manage it right, you can get equipment at prime financing from the bank and not even have to use your tax return sometimes. And there's programs for that. So everything she mentioned on there was very much key and on point. I'm just trying to see if there's anything else here that I wanted to add. She also mentioned about the banks will check your taxes. There's a form called the 4506T. What happens is once you sign that, they're going to go ahead and match up. They get a transcript from the IRS. They will not loan any money to you through traditional financing models if they haven't reviewed that. Because back in the day, people could just, they'll present one thing to the IRS, they'll present another thing to get the loan. And we all know that you're looking to get capital and you don't want to pay most in taxes, so you'll try to look at it strategically to lower your tax liability. So the model is no taxes, no loan. That's what it comes down to, because if you're paying taxes, that means you're making money. So the banks, lenders look at it and say, okay, well, he and she said they're not making any money. Well, we can't give you a loan. You can't just do the link process and get a loan, showing that you're not making any money. And if you have a good tax professional, they'll know how to keep you lendable. And that's one of the first things I look at when I'm reviewing tax returns. I'll look at their strategies and I'll talk to them. I say, hey, what's your strategy? They're telling you write everything off. They're not thinking about the future of your company. So you have to look at where you're going with your company. And that's ultimately, as long as it's reasonable and it's customary, normally you're not going to have an issue. And if you're managing your business, you're getting employees, you're buying more equipment, you're doing all these things that give you the advantage that the IRS does for being in business, then you're going to be in a good position. So we've made a couple different, we tried to scale this down so we could get some one-on-one time with you guys today. So what we're going to talk about is understand what it takes to fund a business loan, various different types of financing, SBA versus conventional, alternative financing, and preparing for your loan submission. So a little bit about me. 13, 14 years commercial loan, commercial banking. I worked with, I started off working with companies that were 2 million to about 100 million in revenue. Decided to go back and get my MBA. So I got an MBA in finance and marketing together at the same time. Took a step down, started working with startups from the banking world. So I worked with the banking with startups that were, obviously 0 revenue to 2 million and beyond. And then I've worked with them all together. So now, ultimately, I stepped out of banking, and as a commercial lending consultant, I work with the A paper to the F paper, traditional financing to the non-traditional financing. And what you'll find a lot of times is that the institution you go to, they're gonna give you the information that they know and what they've been taught. They're not gonna give you the full spectrum. A lot of businesses go out of business because they don't have that information. They don't have someone like Stephanie here who can actually share with you, the ways that you structure, get you set up for success. And that's what this is, that's what you're here for. Ultimately is to set yourself up for success.
What is DMB? You mentioned that a couple times.
I'm sorry, Dun & Bradstreet.
Oh, okay.
So you've got the Dun & Bradstreet, you've got the Small Business Financial Exchange, you've got Experian Business Credit. Those are the 3 in particular that most lenders are going to look at. Dun & Bradstreet by far is the king of them all. However, whenever you're getting any credit, if you're going to the bank, they can't report to Dun & Bradstreet. And you want to get, as she mentioned, as many trade lines as you can, because what they're going to look at, they're going to look at your capacity. They're going to look at how much have you been charged. You talked about erasing, and I can tell you that's the other thing I was going to mention, from personal experience. One of the strategies I've done to help get clients more money is look at what else they have out there. If I see that they have 10,000 approved with us, but they have 25 with Citi or another institution, I'll go up to my underwriting and say, hey, look, if I can get them 30, maybe I can get them to close. Because it's all about, are we helping you grow? If we can show we're helping you grow, they may ask you to close the other one out. That's up to you if you want to do it or not. But those are the things that they'll look at, and that's one of the cheap ways to help keep pushing it up. And ultimately, you want to have as much access to capital with the least amount of personal ties to it. So we're going to talk about why you need capital. We're going to talk about projecting a cash flow. So I gave you guys some documents. Hopefully we'll be able to work independently or collectively together. So what the approach is basically is going through these numbers so that the exercise is designed to help you be able to make sure that you can present yourself to a lender and be able to explain where your numbers are coming from and where you're going, and be able to present it to them, why you need the amount of money. The number one thing that makes every lender cringe is when you come to them and say, I need some money, and you can't tell them how much you need. You can't tell them what you're going to use it for, because that's the biggest flag. And she talked about hobbies, that you're not really serious. If IRS or anyone else doesn't think you're serious, it's automatically a hobby, because you're in the business. Being in business is in the business to make money, and you have to take it seriously because there's too many different risks that you're taking on that will automatically take you out of business. So you got to do your homework, which is what I basically talked about, and that's what these forms are going to do. A lot of people overlook, and John went over, the balance sheet, income statement, and things of that nature. A lot of people overlook the value that you have within your company as you're growing your company. So things like your inventory, your equipment, your accounts receivable, those are all assets that can help you to get more money. If you're leveraging, and she talked about it again, leveraging is the game. You want to be able to leverage effectively, of course. So some of the questions they're going to ask is, are your clients paying you accordingly or on time? So what's your policy? So in other words, when you decide to extend, and she talked about it a little bit earlier, trade credit. When you're getting trade credit, you can give trade credit. I can give Stephanie credit to do business with me. She gave a really good example. That's a strategic example, by the way, of having your accountant offer to report trade lines to you. But me and her can do business together, and we can report the pay history on each other. So if I'm doing business with Stephanie, and I'm giving her terms, as she mentioned before, sometimes it takes 30, 60, 90 days, sometimes 9 months for you to get paid. the bank wants to know, lenders want to know, how are you collecting your money? Because it's all about the cash flow cycle. Money coming in and money going out. How are you managing that effectively? And they're going to look at some of these questions and you being able to answer that. Do you get them to pay for goods that you sold? When do you receive the money on those sales? A sales tactic or strategy might be give them terms. Terms meaning if they pay you early, you'll give them a slight discount. But guess what? You're in business for yourself. You can set your pricing however you want it to be. So you come right back to the same point you wanted to be from the very beginning. These are things that are going to help a lender look at and see, okay, I have a hobbyist, I have a rookie, or I have someone who is seasoned, structured, and is knowing their business. I talked about offer incentives, and again, it's all about the cash flow. Every business has risk, so we're going to talk a little bit about the risks as well. And I gave you a handout that gives you some of the risks. Each business is going to have some risks that are different than others. Real estate, you're going to have different risks than a service provider maybe. You have to be able to identify and anticipate those risks because that's going to be able to show that you've really thought through your business. All these things go into your business plan. What I did was pulled out some of the things that are going to stick out, like a red thumb to most lenders. So be aware of these risks. If you don't know they exist, it looks really bad. It's like it's like going down the wrong way of the street, driving. You don't know that you're not supposed to be going this direction. It's probably going to be a bad thing for you or for the next person. So we've got some handouts. I gave you some research information, some different places where you can get some of the numbers. Someone talked about, where do I make up some of these numbers? And again, I'm not picking on you. But these are some of the places you can go to get some of that information. The Census Bureau, the Bureau of Labor Statistics. So if you need certain numbers, these are all different resources that will give you information that you can plug into the numbers you're putting together. And it's in the handouts, so I know it's a little small, but I'm trying to pack as much in there as much as possible for you. SBA stands for Small Business Administration. So ultimately, what SBA does, they put guarantees on the loans. SBA doesn't make the loans for the lenders. They don't make the decisions for them. So often from experience, you might come to me and ask for a loan, and you might not be strong enough for different reasons, whether it's time in business. So ideally, we want to be able to see 3 years of history. Does anyone understand why we want to see 3 years of history as a traditional lender? Track history. Start year one here. We want to know, are you going up or are you going down? 3 years gives us enough trend to be able to tell if you're continually going up, if you're stabilizing. So 1 year is not enough. You haven't completed your full sales cycle. You might have a business that has a 9-month sales cycle. So 1 year still may not be enough. 2 years may not be enough. But 3 years gives us enough time to be able to see, is this a growing business? Is it a stagnating business? Or is this a business that's just going to fail? So SBA, what they're going to do is so you've got preferred lenders. These are lenders that do not have to go to SBA to get signed off. So when they make the decision, they're already in bed, so to speak, with the SBA. They just slap an SBA number on their approval. Once they're done, they've already checked all the boxes off. You will have to personally guarantee it because it is a government-backed program. So SBA, because they have to make their money to pay off the loans that do default, they need to have some kind of recourse that they can go after to help mitigate that. And it encourages you to not walk away from that loan when they have a personal guarantee. So that's typically why. But ideally, you can only guarantee so much. Once you've guaranteed your home, you either got to go get another home or you got to find another asset. So you want to be able to preserve those personal guarantees unless you really have to do so. And SBA is one of those options. So benefits of SBA loans: competitive terms, lower down payments, flexible overhead requirements. What that means is basically when you're looking at getting a loan, a bank may decide or a lender may decide that they may want to put certain restrictions on what you can and can't do, or what ratios, and I think John went over some of the different ratios, what ratios they want you to stay with under. SBA, one of the loose requirements is you may not need as much capital or collateral. Overhead can be flexible. And a lot of times the SBA loans, they may give you additional guidance. They may give money, but that money may come with making sure that you're successful. So that may be a part of the process. So that could be a benefit. Other characteristics is typically up to 90% financing. So these are general characteristics here because you can use SBA loan for real estate. Now it's only owner occupied. We'll get into that in a second, I think. Investment property is not, it's not owner occupied. Your business is not in that. Your business is not occupying the majority of the income that's derived from that source. So I gave you also a table if you want to be able to find out if your business is SBA eligible. That's the link right there for it. But basically, you have to be a profit. You can't be a nonprofit. You can't be you have to be a business that they consider to be reputable, meaning that they're not certain industries like the adult industry, the cannabis industry. So that's what they consider. You know, some of these things are probably going to change in the near future, but you have to be in the U.S. They want to see that you have some skin in the game. So that's why the 90% is there, because they want to see that you've shown. Now, you can use what she talked about by building that credit. It doesn't determine exactly what skin in the game or how you use that skin in the game, but she talked about it earlier in her example where she says she used the money to go ahead and build up, that she got the construction financing, and then she kept doing it. So that's an example. Again, this is your business. So this is your oyster, this is your world. You have the ability, you have the opportunities. It's about laying out the framework and managing that framework. So I gave some tips on protecting yourself because a lot of people will take advantage of you if you let them. Be aware if you are getting approved for a loan and they want to charge you 40%, then it's going to be a little hard for you to get a return that's going to allow you to make more than 40% on your money. Now, it doesn't mean it can't happen, but you have to take that in consideration. Fees. Always look at the APR, the annual percentage rate. That tells you how much the rate of your interest rate is, plus any costs that are tied into it. If it is extremely high, and you want to get your disclosure, that'll start showing you if you have junk fees or other things that you shouldn't be paying for in it. Fees that are over 5% of the loan value. So in other words, you're getting a loan for $100,000, but they're going to charge you $40,000. Well, that's more than 5%. There's probably something, that's a challenge there. Now, people in the cannabis industry, no one will give them loans, so it's customary for them to have to take something that high. So that would be maybe potentially an exception. Also, never, always sign. Don't leave anything blank because someone could potentially forge your signature. These are all things that you want to be aware of when you're looking at getting a loan. So there's technically 4 different types of SBA loans. You have your SBA Express loans, your 7A, your 504, and your 7A pari passu.
Do we have that paper there?
Yeah, you should.
Yeah. Yes, in the handout.
It's in the handout, okay.
So some of these may not have, you're probably going to see more of the SBA Express and the 7A more than anything else. So the 504 is only for real estate. The 7A can be used for different purposes and real estate. So the SBA Express loan, often, and this is kind of like a variable type loan. So sometimes it'll be given to you as a line of credit over 7 years. The first 3 years will be a line, and then it terms out, so it turns into a loan. But these are all things that they'll express to you. If you have an export business, then it could go up to $500,000, and your business assets are used as the collateral. Typically, 7A loans for a smaller business with larger financing needs. Loans can go up to 5 years with a 10-year term, 7 years for working capital or inventory, and 10 years if you're looking at debt refinance. So if you started your business, maybe you ran up credit cards, you weren't able to exit out, they'll look at offering you a way to restructure it with an SBA loan. So that way you can bring your payments down potentially.
I would just also add to that, believe it or not, you can use an SBA loan if you have a lease, a commercial lease for a minimum of 10 years. You can use SBA financing to do the tenant improvements.
Absolutely, absolutely. And so here are some of the advancements that are available for startup inventory. Now, when we say advancement here, the difference between 100% and that amount is the skin in the game they want to see that you put in. So if you're acquiring a business, typically they're going to want you to have 15% injected into the purchase. Now that could be a period of time that went by, maybe you did a lot of work to get to that point, you want to save all your receipts, document all that, because that comes off that amount. So in other words, if you put, let's say it was, I'm going to make an example here. Let's say it was $100,000 to acquire a business. Maybe you pay $10,000 to attorney fees and all these other things to help acquire it. Maybe you had to pay, some of the leasing for the space. Let's say that was another $5,000. You've met the 15%. So the other 85%, it's almost like you got a full funding on it because you've already contributed to it. And typically the rates are going to be based off of LIBOR or WSJ Prime, which is Wall Street Journal. LIBOR is the London Interbank Offered Rate. You can look up all these rates online by Googling it. So real estate, anyone in here looking at buying real estate anytime soon? Owner-occupied real estate or investment?
I want to say, owner occupied.
Okay. So the test, 51% of the square footage, 51% of the income. So you may have a building, and if you only occupy this little percentage of it, but you rent the rest of it out, SBA may say, you know what, the majority of the square footage is not yours. Also, the income that comes in. If your payments are, let's say $1,000, and you're getting most of your income, let's put it this way, if your income is a lot less than the income you're coming in, if you're renting out a portion of your building, they may consider it not owner-occupied as well. Because they're looking at how's the money coming in, because people will take advantage of it, of course, if they can. There's prepayment penalties, 5% the first year, 3% is a declining prepayment penalty. The third year is 1% after that. There's no prepayment penalty typically. Again, advance rates go up to 90%. The 504 is only real estate and equipment. Most industries qualify, again, the same thing, no cannabis, no adults. You may hear of CDCs, and I'm gonna go to this in the next screen in a second. The CDC, go ahead.
I'm sorry. I was just going to say, I was thinking of building a little house on my property in the back. Is that considered?
One thing I forgot to add is 504 you can use for construction as well. Part of it may depend on how it's zoned. So if it's zoned commercial, and again, this is where you're going to want to talk to, now almost any lender or title company can look up the property and find out how it's zoned. If it's zoned residential, most cases you're not going to be able to do so. If it's zoned commercial, then you'll typically have that. And again, the percentages are typically going to be all the same as it relates to that. A CDC is a certified development company. So you have companies that will act on behalf of SBA. They will so you'll have two loans if you decide to get a 504 loan. The bank will write two loans. One will be a writer. The CDC will write the exact same loan. So the first loan, let's say any traditional bank, you pick whatever bank that you normally think of when you first drive down the street. Let's say they're gonna do a loan for you. They're gonna write a loan for 90%, two loans. One's gonna be 50% loan to value, the other one's gonna be 40% loan to value. You're gonna come with 10% injection. Again, the 10% could be used multiple different ways. It could be maybe research, all down the list that's contributing to you being able to occupy that property. Now, the CDC is gonna write a second loan that's gonna ride in concurrence. So when you actually buy the property, it's gonna pay off the other loan that the bank was doing for 40%. So you have two payments, one going to XYZ Bank or the lender, and then the other one going to the CDC. And the CDCs are there to help. Now, there's sometimes advantages of both, depending on which one. 504 lets you get a much bigger building. That's one thing in particular. Oh, good.
So, I noticed in the 7A there's a prepayment penalty. Is the 504 better program because of the CDC? It seems like the 504 offers more than the 7A.
Well, the 7A has a different application. It's more universal. You can use it for real estate, but you can use it for business acquisition. You can use it for other things, whereas 504 you can't.
It's strictly real estate 504. Period.
Real estate, construction, and equipment.
For Real
For
estate or
504.
for any type of business?
For real estate.
Oh,
Yeah, and it has to be owner occupied, it can't be investment, so you can't go buy an apartment building with it.
okay.
You mentioned that they do 90% as far as the loans,
That's the advance rate.
coming with 10%. Are there restrictions or requirements less strict if you come in with a higher percentage, 50/50 or something like that?
You're just using more of your capital
Yeah.
in most cases. I mean, the lender, if you're doing a 504, they may decide that they may give you a lower rate. You know, most of the lenders, we kind of set our own rate, really, at the end of the day.
Yeah.
And because of the government program, typically there's a lot more secure knowing that. So just to explain how that works, let's say you have a loan, an SBA loan, and somewhere down the line, let's say you started off with a loan for $100,000, and let's say somewhere down the line you have to close up shop, you can't pay the loan back for whatever reason, you file bankruptcy at $50,000. SBA is going to come in and guarantee they're going to pay the bank, the lender, $25,000. So the bank really only lost $25,000 out of the whole deal. So there are times where sometimes government may come in and push SBA or push lenders that they may advance that guarantee amount. So it makes the banks or lenders more willing to make loans when they may not have. Does that answer your question?
It does.
Okay.
I just have one more, sorry.
Yeah, go ahead.
So for the 504, no strip mall, right? No
That's an
strip
investment.
center investment, but I can, like, say for instance, if I want to develop and build a bakery, I can do that with 504.
You can if it's going to be your business.
Yeah. Okay. So it's personal business versus just.
Your business.
I mean, you know,
I understand.
I'm running
I understand.
as an entity.
Correct.
Versus me leasing it out to other people.
Correct.
Okay.
And also, just as a bonus, in terms of entity structures that most lenders like, they like the C corps. And the reason why is
They like
because
the C what?
C corps. C corps get double taxation. Remember what I said? If you don't pay tax, they look at you as you're not making money. So the more money you're making, it's correlation. That's kind of typically, and Lauren goes into all that in more detail as well. But that's just a little bonus for you. So 7(a) pari passu. A lot of lenders don't know about it because this is more of a kind of like a special weapon, so to speak. Typically, this is to entice lenders to want to lend more in some scenarios. So in this case, the lender, and I gave the example here, allow you to go up to $7 million. You still have the same prepayment penalty. However, and I put it down here, the first loan is guaranteed to the first $5 million by SBA. So if $5 million out of $7 million, they're guaranteeing the first 5. So it's a special scenario when they have to go to that. That's when that kind of comes into play. So it works well when credit markets are tight, again, to induce banks, lenders to want to lend. SBA normally will take a second lien position on the property. So types of conventional financing: commercial real estate loans, business line of credit, business credit cards, equipment financing, vehicle financing, and commercial small business loans. I talked about SBA actually already earlier. You've got 2 different types of properties: owner occupied and investment. And I talked about that also as well. The percentage of revenue or the space utilized by the business will determine what type it is. So you will have, normally when you think of residential lending, you've got 30-year fixed and things of that nature. In commercial real estate, that's not the case. There's so much more money out in the market. They want to be able to keep money out in line with market. So you'll have terms of 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 15 year, and then it'll be amortized by 25 years. Meaning your payment's gonna be as if you were paying it over 25 years, but in 15, 10, 7, all the way down to 1. That's when your loan is gonna be due or needs to be refinanced. And so what happens is, instead of putting money out for 30 years and the credit or the market goes up and down, interest rates go up and down, they can keep putting money out relative to the going market rate every 1 year, 2 year, 3 year, 5 year, 7 years. Does that make sense? Does anyone have any questions about that?
I do.
Yeah.
Is this like a fixed rate?
It can be fixed.
Can be.
So it can be a lot more open, you can do variable or you can do fixed. So you can have a variable rate, and in your documents, they'll tell you how often it can adjust. That could be on a 1 year, 2 year, all the way through. Now, you can also have a 5 year doing 5 years, so it's fully amortized. This is not a fully amortized loan. It's 1 to 15 years amortized over 25. Does that answer your question?
Makes sense.
Okay. So, yeah, go
On
ahead.
the 7A, you talked about, you might have 10% injection. It could be research. What qualifies as research?
So you may, let me think here. Let's say you have a manufacturing company, and in order for you to, you may have applicable costs that were associated with you being able, it could be tenant improvements. That's an example. If you may have, and this is where it gets a little dicey with your accounting and your legal, but maybe it requires certain research for you to be able to make the improvements you need to the building. That could be an example of how research could be a part of the attributable capital contributions that you made.
Research, you're finding out what's needed.
Correct.
Thank you.
Owner-occupied, typically owner-occupied traditional, you'll have, if it's not SBA, typically it's going to be capped at 80%. Remember I talked about a benefit of SBA? You go up to 90. So if you have an extra 10,000, not 10,000, 10%, that's more you have in your bank account that can make money for you versus you tying it up in a building or equipment or whatever else there may be. Again, same thing, the amortization and the terms are the same. So the 1 to 15 years is considered a term, the 25 is the amortization. Again, that's what you're calculating your payments based on. And to answer your question, it could be variable or, no, it could be variable or fixed, not a problem. And again, for it to be occupied, and this is kind of redundant, 51% of your business space or 50% of revenues must be coming from it for it to be owner occupied. So business lines of credit. And I'm going to talk about business lines of credit versus credit cards because you use them differently ideally. Business line of credits are typically used to strategically manage cash flow. One of the ways, for example, might be for payroll. Another one may be to take advantage of discounts. There's different reasons that you'll use the line of credit. They typically start at 10,000 and up. So if you're going to a lender and saying, hey, I need a business line of credit for 5,000, typically they're going to say, we'll get you a credit card. Because to them, it's the amount of work that goes into it. It's not really worth it for them to start at anything less than 10. It's revolving terms. It's the monthly payments are typically interest only. Anything under 100,000, typically you can get away with not having collateral. Anything over 100,000, they normally want some kind of collateral. That could be real estate, equipment, cash, accounts receivable. Those are typically the main collateral pieces that you're going to have available. And actually, I'll talk about that there. Inventory perishables, typically not so much. And the reason why, because it can perish. So if you're using tomatoes, as your inventory, you're going to say, well, what's the likelihood that we can use that if we had to come in and liquidate? It's probably going to be gone by the time we get here. So just wanted to put that in there because we always get inventory. Well, I've got a bunch of this. And you have to think about that in terms of risk. All this is about risk management from the bank, from the lender. Business credit cards, typically start at 500 going up. From a traditional lender, typically it's going to stop at 50,000. It can go above 100,000. Typically there's going to be more charge cards or corporate cards. And these are going to typically, ideally, and this is just some tips, once you get it, you can use it for whatever you want. She just gave the example how she strategically used it for construction, and that's kudos to her. Because what the lenders are looking at is how are you managing them. A lot of times all they see is it went up, it went down, it went up, it went down. That's what they're looking at. They can't always sit in and zero in on Stephanie, oh, let's see what she bought today. No, they're looking at, is she using it? Another tip, if you don't use the credit, you're considered a bigger risk.
Yeah.
And can anybody explain why or give me a reason why? So if I gave, go ahead.
Unplanned,
Hmm?
to not use it, it's unplanned, so when you start.
In essence, that's the point. When you do use it, it's unplanned most likely. That's the fear. So if I gave you a credit card, a line of credit, and I gave it to you January 1st, and here we are November 2nd, and you never used it,
Right.
maybe I gave you 100,000, you've only used 5. I'm probably gonna go ahead and bring it down to about 10. Because now when you wanna use it, guess what? You're gonna say, Ambro, hey, what's up? I had a line of credit, I need to do something. Now I can say, well, give me your tax returns, give me your bank statements, now I have a chance to check up on it. And you'll often see this a lot, another tip. You'll often see this when lenders acquire each other. So if you've got a line, because they didn't give the loan out. If me and Stephanie are both lenders, and she gave you a bunch of loans, and I'm acquiring her, well, I don't always get to see every single one of them. So there's tactics that they'll use to try to get you to bring them in so we can know who really qualifies. So if you start hearing someone might be acquiring someone and you've got some lines of credit out there, strategically think about that.
Don't banks sell debt to other banks pretty frequently?
Well, what I would say is it depends. Most of the ones I worked at like to hold their paper. They like to hold with their investments. That does happen, but that's going to be different typically than a lender acquiring another.
Gotcha.
One that's acquiring another, they're looking at what they wanted that company for, whether it's market presence or other different things. Everything that came with it may not be exactly what they was. Kind of like when a company buys another company, they may not need all the employees. It's the same exact thing.
Also, it might depend upon their portfolio risk.
That's another one, too.
If they have enough
Yep.
investment in a particular asset, a lot of times people will go to the bank and the lender will say no, and the person doesn't realize that it's not no, other than anything more than they've already got too much money invested in that particular sector, or they don't lend to your business because they don't want
Absolutely.
to have the risk of that portfolio.
Absolutely.
So that's again another reason why you need to you need to have banking
You need to have
relationships,
multiple banking relationships.
because the
And-
portfolio is switching.
Yep.
Are there any advantages to when banks consolidate or acquire each other?
In my eyes as a business owner, it's probably minimal. It could be location, it could be reach. I mean, there's different things that come into it, but in terms of growing my company, my business, not really. Maybe like for example, I had one lender that hated car washes. They couldn't understand why anyone would pay to get their car washed. They couldn't. But I'll tell you why, where the underwriting was located, it did nothing but rain. So people don't go and get their car washed all the time. They don't understand. This is why you need multiple relationships. Because if they don't understand it, it's a whole lot easier to say no, which is why the emphasis of being able to tell your story is so important. The better you can do it, the better they can understand it, the better they're more likely to approve it. And I've had in my own personal experience, I'd say probably half my approvals are originally declines. Half. And what I ended up doing was understanding the other piece. I walked through it with them. Now, not everyone you can get a loan because different reasons. They may not like the industry. They may not like it. You know, a lot of institutions don't like construction because of the litigation. Another thing, another tip here. Lenders typically don't like when it's real easy for you to be able to get in and out of business. If you could just take a test today and you're in business, it's totally different than the doctor who had to take 12, 15 years. What's the likelihood they're going to skip out on that? All this is about, again, the risk management. It's all about, you know, you being able to tell your story and being able to back up what you're talking about. Other forms, sorry, I didn't ask that question. Other forms of financing, again, you've got equipment, and I'll go into some of these other ones real briefly. So we'll talk about the different types of equipment. I'll give you another example, it's another tip. You may have purchased a piece of equipment, and normally less than 6 months, if you needed to get some cash, you can do an equity recapture, which means you basically take a loan out against that equipment as if you were getting it today. They're allowing you to pull back the money in that equipment to the degree that there's value, and now you have equity that you can use in your business. Now, there's different types of equipment financing. Asset-based lending is based on the asset. That's what they're really concerned about. They're not concerned as much about the cash flow. Unlike traditional banks, it's based on strength of that's based on the financials of your company, which kind of we went over before with John. This is based on the market value of your asset. So accounts receivable, inventory, real estate equipment, or real estate. You want me to go back for you? Okay. All right. No worries. Purchase order finance. What this is, maybe you have a manufacturing company. This is one of the better examples. In order to do what you need to do to sell to who you need to sell, you need to buy this piece of whatever to either assemble it, to make it, in order to sell it. Purchase order finance is going to allow you to get that, whatever that is, that raw material, that piece of equipment, or whatever it is you need, so that now you can do what you need to do to sell that item. Typically, this is going to be an alternative lender. They're going to normally want to get paid off by another lender. It's for them risk management. They want to be able to know that you have financing in place. It's almost a double layer for them. Merchant cash advance. I would say this is last option. Now, it can be, a decent option, but this is going to be normally your higher interest rates. It's going to be based on your ACH sales. Advance based on generated sales by credit. It's typically one of the riskier forms, but it is something available. And they normally will tailor it to the cycle of how your income comes in. So that way it streamlines your revenue and your cash payments. And again, often used at last resort. Accounts receivable factoring. You may, and Stephanie talked about this earlier, you may need to pay your people today, but you may not get paid for 30, 60, 90, 9 months. Well, that's a form of you selling your asset. Typically, it's your receivables. That's on that balance sheet. That's considered an aging asset. And why do we call it aging asset? Anyone take a guess? Because it's worth less the longer time goes on. Just like your friend, your cousin that borrows money. They're more likely to pay you if they got the money they can pay tomorrow than it is 10 years from now. They're going to forget about it, other needs come up. It's the same thing. A lot of people don't understand or realize it, but it's one of your more common forms. It's business to business, so it's not regulated in the same fashion. So if me and Stephanie decide to do business and I'm going to buy her receivables, I'm making that decision directly with her. So it's between me and her that made that decision. So she needs to make sure she's got her ducks in a row and she's reviewed everything. She's talked to her accountants or attorneys or whoever. Same thing with me. So preparing for your funding, find the funding, prepare proposals, prepare your submission for proposal. You'll get your award acceptance, get your award set up, monitor, and close. So research your lenders, because everyone has a different appetite. That's why you need to have multiple relationships. Some may not understand your business, some may not care about your business, some may acquire the other company, so they may have a desire, may not have a desire. Be prepared to know what you want, what you need. Recommend having a business plan. And I said, even though it may not be necessary, the reason why I say is because typically all of my deals, the only time I've used the business plan in most cases is to help me do my write-ups. I'll look at it and I'll say, okay, because we're tasked with time, I've got to talk to so many people, I'm going to get right to the point and find out what I need to know from you. Now, you do need to have a business plan because you need to know where your business is going. You need to be able to go down the road and be able to look back and see, oh, am I off course or am I on course? But for a lender, a lot of times, me and most of the peers, we typically didn't really use it. We only used it to help us to better understand. If I've talked to 30 of you, to try to remember exactly what she said and what she's about and what she's doing, it'll help you with the business plan. Reach out to your lender, find out if there's any particular, I gave you a checklist. This is a comprehensive checklist. So in some cases, they may not need all of it. They may only need a portion of it up front right away. But again, it's better to be prepared. It's better to know in advance that these are some things that they may need to want. And the other thing is I would ask them, no lender's gonna want to give you a decision on your loan, but a lot of times they'll kind of give you an idea, you're on the right track. That'll give you a chance. Because once you submit it, you can't take it back. You can't say, oh, you know what? I meant I was gonna make X amount of dollars. That's not gonna happen. Once it's in, it's in. So if you can get a chance to get a feel for what they're looking for, or whether or not they understand or they're comfortable, if they've done deals like this before, then that'll help you a lot. And then ask for the turnaround time. Because every day that goes by that you don't have the capital you need is days that you're not making money or your business is not where it could or should be. So find out what their turnaround times are. Because once you find out, they say, hey, we make decisions in 24 hours. Well, in 48 hours, something's up. And they may not always come back to you and tell you. They may just be too busy. There's 30 people in here. I can't tell 28 no's and get to the 2 that are yeses. The 2 that are approved, that's who I'm calling back first.
Right.
That's just how it's going to happen. So again, you have to take ownership. This is your business. Find out what the turnaround times are. The checklist, you guys have that. A lot of times you don't have to recreate the documents. So I gave you the personal financial statement that came directly from the SBA website, so you guys can use that and have that. Normally they just want to know, is the information still accurate? Oftentimes I would take an application and use the XYZ bank. I'd give you mine. Check off the character questions. Have you ever had a felony? Have you ever, all those different things, bankruptcy. Sign it, I'll attach it together, I'll send it in. So doing it once and being able to have it as a reference may go a long way for you. And any additional questions?
Could you speak a little bit about CDFIs, so community development financial institutions?
Yeah, so CDFIs, I'm glad you brought that because I could have put that in there too. Organizations, companies like CDFI, they will often receive funding from a lot of institutions to help businesses and companies to get loans or get financing where they may not have otherwise. So you've got a lot of resources out there that can help you. You've got SCORE, you've got other different groups. So some lenders, they may not lend to us it helps them extend their reach basically by being able to lend to other companies that will do all this work and sometimes hold your hand a little bit closer to make sure that the money is not going to bad use or that's being used more effectively.
As part of the program,
Absolutely.
we're connected to a CDFI, so
Yep.
that's why we're specifically doing this, because we have a relationship with Lender Street, who manages the
Yep.
CDFI accounts.
Absolutely.
I know for SBA, nonprofits don't qualify, but for conventional funding, nonprofits do qualify, correct?
Say that again, I'm sorry. I couldn't think and pull it out at the same time.
Regarding nonprofits, I know for SBA, nonprofits don't qualify at all for SBA, but for
Correct.
traditional, conventional loans, nonprofits are not exempt, correct?
You can definitely, we've done them. Typically, there's groups that provide that type. There's normally special groups within different lenders or groups that will concentrate on that particular area. And so there's different buckets sometimes that they'll provide that financing through. But normally you're going to look at your community lender. I mean, there's different titles at different institutions, but that's what you ask, who's your community lender or your nonprofit lender? Sometimes it might be me. Sometimes it might be, someone who only strictly focuses in that space.
I have a question. I just want the word startup kind of clarified for SBA because it seems like you need to be in business about 3 years, you need taxes, there's so many things that is qualifying that you have to have, that in the mind of some people as a startup, it's like, oh, I thought of this idea, I'm gonna start up and I can go get a loan. But it doesn't seem to be that cut and clear. It seems like you're gonna have to have, like you said, been in business, had some cash flow, 3 years in the business, we wanna look at your tax returns, we wanna know where you're going, exit strategy. That to me doesn't seem like a startup company. So I just want some clarification on what SBA is saying is a startup company, because most people, when they start up, they're starting up, they're at the bottom. They need to get, $25,000 to get started. They don't have 3 years of tax returns. They don't have, Dun and Bradstreet cards. They don't have a trade line. So where is the medium so we can understand exactly what SBA is saying a startup is to them to give them a loan?
So a couple of things. A startup is a startup. I know it's going to sound like a play on words. SBA only guarantees in most cases.
Okay.
There are programs that are involved. You've got microloans. Some of the CDCs actually provide microloans. Some of them will lend based off of your credit history, personal. So you've got different funding sources out there. It's one of the reasons why I wanted to throw the CDC up there. It's only so much you're going to be able to compact, of course, in a session. But a startup, you have companies that are established, and they may start up a division. They may start up, it just means there's no history. So you have to go ahead and some now, if you already have another mom and pop business or bigger business that can help fund that, then of course that's one way that you're able to do so. However, it's still the fundamentals are there that you need to be able to show this is where you're going, this is how much money you intend to make, this is how much you think you anticipate it's going to cost you. And the better you're able to do that, is going to help lead to your success. She mentioned earlier that your personal credit can be, and I'm gonna kind of add to it, could be your best friend. If you got good credit, what they're looking at is characteristically, how do you handle your personal credit is a good chance how you're going to handle your business credit. So they're going to look at that, and anytime they can get a personal guarantee. And I'm glad she brought that up in terms of the business credit, because anytime you can get more guarantees, that means it's less of a risk. If I can go to Stephanie and say, okay, Stephanie, I want a personal guarantee, but I can get everybody else a guarantee in this room as well, what's the likelihood I'm going to get paid? It's a lot better. So to answer your question, it all comes into, and that's why I gave you the document, the startup cost analysis. That's going to help you articulate how much money you really need, from the personal side as well as the business side. Because lenders are going to look at a global picture. They're going to look at the business. Can the business stand on its own? And that's part of what she's sharing with you as well, showing from day one. The sooner you can start doing it, the better. Because then you can separate your business. Your business runs on its own. It doesn't need personal influence for the business to run. So starting up, you want to be able to do as much as you can, prepare yourself for that, and show that you're a bet worth taking on. I can give you an example personally. I remember I had a young lady, so age doesn't matter. She was selling like $1 and $2 items in a concession stand in the mall. Had no business plan, and we got her approved. It went SBA because typically what happens is lenders don't want to abuse SBA. There's only so much money available to secure and cover all the loans that are out there. So there's a percentage of it. So they're not just going to throw SBA on it just because. But if they need to, whether it's time in business, whether the cash flow is not there, in other words, you're not making enough money that they need to see to be able to meet the fair guidelines of showing that they're lending everyone equally and the same, they may need to put an SBA guarantee on it. Some cases, that may mean they can give you more money. So SBA is going to help enable the bank, encourage the bank lender to want to provide you the capital you're looking for. Now, you're not going to have an SBA on credit cards, because that's totally different. But you can have an SBA guarantee on lines of credit or business loans, commercial loans. Does that answer your question a little bit?
A little bit, yeah.
Do you know of any specific banks that are, lending more money to a specific demographic or a specific industry that we can connect with more frequently?
Honestly, I don't know, but I would focus more on building a relationship, because the better you're able to the better you can focus on your business success and why they need to do business with you and why they would be because here's the thing, every bank wants your deposits. But not every bank wants to give you a loan.
Right.
And so, and because there's risk involved in that. Right? You know, you giving them your deposits helps them to make more loans to whoever they want to make it to. And so the time that you're spending on trying to find one, you're just better off cultivating a relationship with the banks, and you'll find out there's a lot of different questions you can ask. Who have you lent? And really you have to develop that relationship with the lender. Because I can give you examples again. I had one particular construction company that had went to the same bank that I was at, tried 2 different bankers and got denied, and I was able to get them approved. So it's not just the bank, it's also the person you're working with in the bank. Because the person in the bank may send up a bunch of junk deals. Underwriter says, oh, this is, Bob again sending up some stuff. What's the chances that they're gonna, you know what I mean? Like, but here's the thing, most of the time you look up, oh, I'm gonna walk into the bank. And they're in business to make money, just like you're in business to make money. So you wanna learn the game, you wanna understand the language, you wanna be able to articulate where you're going, where you're coming from, and why they should go ahead and actually do business with you. Create competition. It works in your best interest.
Talking about business bankers and branch managers, or the other relationships at the bank you think we should have?
Branch managers now don't have the same power they used to have, unfortunately. It used to be a point where, depending on the bank too, the smaller the bank, bigger bank doesn't mean better bank.
Thank you.
I've worked at big banks, I've worked at small banks, and all of them are great. But the thing is you need to know that who you're working with has a vested interest or is really trying to make sure you get approved and give you the right direction. That's why I gave you some of the tips. Find out how long does it take. Because they may be backed up. They may have a promotion, they're waiving fees, this, that, and the other. So it may be a little longer, and that might be the reason. But their standard turnaround time is 48 hours. Why is it taking you 84 hours? Why is it taking you? You should be able to know when, where your loan stands at. And they should be able to, a good lender can typically look at your deal and know that you've got a good chance or not. 10, 15 minutes. 10, 15 minutes, I can go through and look at it and normally tell. But everyone starts somewhere. So the experienced lender may not have time for you. The newer lender may have the time. You know what I mean? So it's all about, and that's why I say I wouldn't focus on so much a particular lender. Everyone's gonna have their commercial pitch. You gotta be able to cut through the noise and realize, okay, this is where I'm at. I've seen tactics work with clients that would have never worked with a bigger bank, with a smaller bank. And vice versa. You know what I mean? So it really comes down to, this is my business, I'm prepared. That's why you have to know your stuff and be able to be prepared. And as you're talking to lenders, you'll start getting a better feel universally what's right. From the fees, interest rates, everything, because it's moving targets. Any other questions?
I'm starting a nonprofit, and I'm finding that my personal credit is becoming very important because I'm new. I recently paid off 2 credit cards. My question is, should I close those credit cards or should I keep them?
My recommendation is never close your credit.
Exactly, and never pay them off, because then they have no reason to report, so your score is gonna drop immediately. Pay them down.
Now,
to 100 and.
I gave you the example earlier. I use credit cards as an example. I may say, what's your name?
Margie.
Margie. I may say, hey, underwriter, Margie's, got this over here. We need to bump it up. What can we do? They may say, okay, well, if Margie will close it, that's up to you to decide to do. Now, I typically tell clients offline, here's what, here's what it is. Now, that's up to you to decide, but is everyone going to be able to do that? Is everyone going to be that personable? Is everyone going to have that time to do so? You know, so those are all things that you have to consider and look at. You're closing your trade history when you close your credit. So that's why you want to guard that, protect that, because you're building something that's bigger than being at one particular institution. And sometimes you have to switch, because I can tell you, doesn't matter how big you are, if they're done with your industry, you can be out. They'll tell you got to go somewhere else. You know, and having a solid presence, you talked about it online. A lot of people don't realize, and having a bad website can hurt you even more.
Having a bad website?
If it looks real tacky,
Too long.
yeah, they can't tell what's on there or what's in it, you know what I mean, or what's going on. You know, it looks like a hobby. You know, it's yeah. So those are all things you have to look at. Keep peeling onion back. You know, look at your competitors. What are they doing? Where do I stack up with them? You always need to be looking at your position and how you're being perceived and how your company's being perceived. And that's part of where personal credit comes in. Because some may want to look at it just for that purpose. They want to see what you've done. Another tip is if you've got charge-offs with some lender or some institutions, it may be a little tougher because lenders don't want to get burned twice. They got burned one time. I had one. It was under $100. Literally, it was under $100. We couldn't do the deal. They didn't care if they were paying it off now. It's like, you know, they think of it as, hey, you know, we need something, so we're going to pay you back that money because we need some more money. You know what I mean? So you have to look at, you know, this is all about your due diligence. So again, that's why I say when someone walks up and says, hey, what do I got to do to get a loan? And then I ask how much money you need. You know, I'll take like 200. You know what I mean? That tells me that you've done none of the stuff in between that's gonna, you know, and everyone's getting scored. And I won't say it, but you're getting scored in terms of who I'm gonna talk to first, because we're trying to do as much as we can to help as many people. It's time management. What's gonna take the longest? What's gonna be the quickest? So you want to be able to make yourself shine and rise to the top as someone that they should do business with.
Amber, real quick, you said about a topic regarding paying off your credit cards. Well, what about those crazy people like Macy's and Nordstrom's and those are department stores that some people love. Not like me. I don't shop at Nordstrom ever. But suffice it to say, at some point in time, I'm gonna pay it off until I go shopping again.
Yeah.
But I don't close it. And then sometimes there's some people say, don't have all these credit cards, department retail credit cards. And so, what is the true blue of that?
Okay, so what's the actual question? Because I heard a couple things. I don't like Macy's. I don't like Nordstrom. I love Macy's.
Be careful, what you're saying.
Well, here's the thing. I just say,
Shift
do it
those to
strategically.
corporate cards
Exactly.
so that you're doing business purchases.
Exactly.
It just looks different. If it's personal, it looks like you're just out. If it's on your ASS, it's not an asset.
Yeah. Well, that's the thing.
I get it.
That's the thing. You have to.
Nordstrom's those corporate accounts?
I'm sorry?
Nordstrom's
those corporate accounts?
Everybody does.
They all. It just is.
Because they all do business with the government, they all do business with corporations.
You have
So-
to continue to think about how you're being
Yes.
perceived and how your
if
company.
your business has uniform or professional dress, this is our uniform, right? So, yeah, we gotta have the uniform. It's a uniform.
Absolutely. I'm sorry, I came up first, but we'll get you next.
In other words, if you have a corporate account with Nordstrom's or Macy's, be careful of your purchases.
What I'm saying is, in terms of, if you have two cards to choose from, if you have a corporate card you can choose from or a department store card that you can choose from, if you're going after, I would recommend using the universal one because it's looked at differently. It's all about your perception. Think about how you want to be perceived and how a lender is going to think of you, whereas a hobby versus a business versus a corporation.
And I think it's the same thing, Ambro. If you think about something like the Home Depot card, I have a regular consumer Home Depot card. I have a business corporate Home Depot card. When I'm doing something for rental properties that I know I'm gonna be able to, I'm gonna write it off, or I'm gonna use it to tell how I'm upgrading the property, I use my corporate card. But when I'm shopping to fix something in my house, I use my consumer card because I keep my business and myself separate.
Absolutely.
And that's what you have to really be aware of. Keep yourself separate. Don't let these things overlap. Many times when we're in small businesses and startups, we're like, well, one bank account will do, and we pay our bills, and we rob Peter to pay Paul, and we just switch the money around, and we don't keep it separate. We need a separate account. You need a business account, and you need a personal account. From your business account, you make money, you write yourself a check that you paid yourself. So now you start having payroll to yourself. Every 2 weeks, if it's $10, I just paid myself, boom, that's the money. But your business account stays over here as your business. You don't start dipping into it like, well, I'm just gonna move this around a little bit, and I got only my business ATM card, so I'm just gonna get 20 out real quick so I can run over here, go to the farmer's market, and then I'll be able to come. No, that's when it looks like a hobby. So you gotta legitimize yourself by having a business and keeping your personal separate. You're going shopping for Nordstrom's because you really just want those new shoes, don't think you're gonna write those off. You're not gonna write those off. You're not gonna write those off. So just put them on your consumer card and go ahead and bite the bullet and pay for them. And when you're getting ready to go and shop for something else, uniforms for your employees, if you really want to get your employees gifts for Christmas or something like that, and it's on the corporate card, then you do it on the corporate card. But you've got to keep the two separated. And that's where we get messed up from the very beginning.
That's where most people fail.
Yeah.
Whenever someone's looking to file a suit, first thing they're going to go after is, because I don't know what the percentage is anymore, but the majority mix at some point. They're going to dive right through and see, did you ever, because all it takes is you doing it once. That's why, again, this is serious about having everything calculated out, because it could be as harmless as she just mentioned. You know, I can't use this card. I'm denied buying this at the grocery store. You know what I mean? I'll just use this card. And now you're piercing your corporate veil. So the money you spent going into doing all this, you could have just, you know, ruined it right there.
And it's fun to dance around as a hobby for a while. I did hobby stuff for a while and wrote my taxes off and everything, and then I started making some money, and my tax account was like, hey, I got good news and bad news. You gotta pay some taxes this year. You paid some money. I'm like, what? You're supposed to keep me so I don't ever have to pay taxes.
But this is part of your
He
projection.
was like, you're in business.
And this is
You're
part of your
making
projections,
money.
though.
Yeah.
Because you should be accounting for these things.
Right.
So that way it's a bonus that you don't have to pay more than you anticipated or you planned for. So, you know, the other thing is when you're selecting your accountants, normally the person who's been doing your personal taxes is not the person. They're not the person. And ideally, find one that knows your industry, that has clients in your industry. It goes a lot further than you think. They've seen other things that other people did. They may even be able to connect you with people for business. So there's a lot of different things, and that's why I keep saying, keep peeling the onion back, keep thinking, let me dig deeper, let me go a little bit further. What if, you know, all the W's, who, what, when, where, and why, that you can. You're gonna say something, right?
Oh, yes. What's the minimum that SBA will guarantee? Minimum amount?
SBA is going to guarantee whatever the traditional lenders are putting out typically. So in other words, lines of credit are typically 10,000 on up. So that would be one example. Same thing with business loans. I believe business loans are 5,000 at the minimum. But you're going through, you know, in most cases you're going to do a credit card. Yeah, because you're going to get that approved with a credit card within hours. You're going to go through paperwork, processing, underwriting. But yeah, typically it's going to be 10,000, 5,000.
Let's give Ambro a round of applause.